we're going to talk about really exciting stuff. You've seen me around on Debbie, worked for DOC, AUHF for 20 plus years. And the reason I'm here today is because I spent that entire 20 plus years shepherding projects through what we call the policy clearance process. That involves the ESG elements that we're going to talk about today. And it's a whole separate realm. So you have your commercial due diligence. Then on the other side, when you're working with the DFI, you have this entire ESG policy diligence process. And can be a bear. So what we want to do is pull the curtain back a little bit today and show you some of what you can expect and hopefully help you prepare for that eventuality. And it doesn't apply just to if you're applying for money from DFI. It could apply if you're working with an impact fund or if you're working with a financing entity that's getting money from a DFI. Those standards are going to be pushed down to you as a beneficiary, the ultimate beneficiary of that money. So we're going to be sharing, I've got some experiences to share, and I'm going to turn it over to Pamela to kick us off.
Good morning. Nice to see all of you. So as Debbie said, well, maybe I should introduce myself first too. I'm Pamela, and I worked for IFC for many years and was the head of the Housing Finance Group under the Financial Institutions Group. But I also worked for Fannie Mae for many years in the United States. I was with a private equity fund in South Africa for 10 years that was doing affordable housing. Now I'm on TMRC's board. I represent IFC on the board, and I'm doing some consulting. And Debbie and I are both involved in a small not-for-profit consulting group that's part of the George Washington University initiative for ESG. And through that, we're trying to help people get prepared for these ESG due diligence that you might be going through, or just if you're trying to set up your policies and procedures for ESG for your company. So we, as part of, forward. So today we're going to really start with the big picture. And what we're, as we said, if you are seeking funding from any of the DFIs for an impact investor or any investor or lender that might be using DFI-based funding, you're going to have to really tackle this ESG issue. And so it would help us today to make sure we're on the right track, to kind of do a little survey and try to get some feedback from you. So today, would you say your understanding of ESG policies and procedures are low, somewhat, or very high? How many of you feel like you have a very high understanding of ESG? Okay, good to know. And how many of you think you have a somewhat knowledge? Okay, that's what I would have kind of expected. And how many really feel like you hardly know anything at all about ESG? Good. We have some honest people. That's very good. So Debbie and I both are very laid back. And we want today to be very useful to you. And so we want it to be interactive. So please feel free to interrupt either one of us. Ask questions if you don't understand what we're talking about, or you want to share an experience of yourself in what we're talking about. We'd love to hear your story as well. So please do feel free to jump in. We'll try to take pauses, make sure we're all on the same page, but do jump in. So one of the things that our little social impact group did for this conference was we developed a handout for ESG, and that's going to be given to you as part of all the materials that Keisha and the others are going to be sending out from the conference. with all the presentation. And I think it'll be very helpful. It'll really address everything that we're talking about today, give you a little bit more detail than we're going to have time to go into today. So you should really look at that and be expecting that with the materials. But so as we said, ESG has become critically important for fundraising, but it's important. We need to look at our business, all of us need to look at our business from the ESG lens, because it really does help you to see the big picture of your company. Because you're going to see as we go through this today, it impacts all of your investment decisions, it impacts your processes, your policies, your mainstream business, and it's a real competitive edge. It really helps you to stand out from your competitors, that you're really addressing these issues in a big way. It is one of the key factors in why it becomes so important to the DFIs and all the funders, is because it is a critical risk management tool. If you are looking at all these things we're going to talk about today for your own institution and for all the institutions that you're doing business with, you're going to see that this really does help you manage your risks of your company. And we're going to talk about that in a couple of different ways as we go through this today. And then I think it'll become more clear. But one thing we want to make very clear is, especially if you're early in this journey on ESG, is you've got to look at it from both your own company, what are we doing, what are we looking at, but also for all the people you do businesses. We're all housing related businesses. So if you're a mortgage company, you've got all the clients that you do business with. If you're a developer, you've got much different risk profile, and we're going to talk about how you look at that risk profile. If you're someone like TMRC, you're going to have your business that you have to look at. So we're going to talk about how you look at these different risks, both from your own corporate level and what you need to do at the corporate level, but also what you need to think about in the project as you're developing new products, new services, new customers, your own people. It really is your way of looking at, as we say, the big picture of your customers, your consumers, your stakeholders, your own people that work for you, and your planet, because we are looking at the environment as well. So it really is the big picture. And we're going to talk about the different risk profiles of your business and how you look at those differently for your own corporate level and for the project level. But we also, one of the first things you might want to think about as you're thinking about starting on this journey for your company is, have we already developed ESG policies and procedures? Do we have we done a gap analysis? Do we know where we are? What do we have and what do we do not have? You can do that on your own. You can hire a consultant. There's, many different ESG consultants out there now. All the big accounting firms have consulting companies doing ESG. The DFIs might provide you some resources through advisory services or capacity building. There's a number of ways you could tackle that, but you might want to first start to think about, have we done our own risk, our self-assessment or a gap analysis? Do we know where we are or where the gaps are that we don't have done? So with that, we'll move on.
Yeah, that's one of the reasons that Pamela and I are working in this little nonprofit, is because, people need help with this gap analysis and developing the policies. It's much better if you show up with your application and all these issues thought through in advance. Much better if you can do it that way. But, you know, if you go to a big accounting firm and cost you an arm and a leg to do that, we want to promulgate a policy. We want to make it easier for companies. And so we set this up as a nonprofit, so it's for the greater good of our industry that we're doing this. Okay, so when we think about at a DFI level, when we think about ESG, we think of it in terms of risk. And the risk associated with each of these categories, the governance, environmental, and social, varies, as Pamela said, depending on what kind of activity you're talking about. So construction development, typically would consider this to be medium risk activity because most of the time it's a family-owned entity, and it's a single entity. You might have, if you had a corporation, like I'm trying to think of an example. In India, it's very common to have these conglomerates, and there are, you know, many affiliated companies in the governance chain that are doing business with one another, and maybe they're also publicly traded. So there could be a lot more complex governance issues for an entity like that than there would be for, you know, a simple sole owner or closely held construction development company. Construction development activity is definitely high risk on the environmental side, and the DFIs would classify projects from an environmental standpoint. They classify them based on the projected impact that project will have on the environment where it's taking place. Category A is the highest risk. We'll talk about that a little bit more later with an example or two. But category A means generally 2,500 units or more in one location, but it could also have to do with the location. If it's in a climate vulnerable area, for example, or if it's near a waterway that has, you know, the possibility of impacting waterways. So there are various reasons why a category A could be assigned to a project. It's a good idea to have a sense of where you're going to be with that before you go in, because usually category A diligence is much more time consuming and involved. Social risk in construction development is also considered to be high. We'll talk about that in some detail. On the consumer financing side, the governance issues mainly have to do with regulatory compliance, although you may have some issues that I spoke about earlier with affiliated companies doing business with one another. So if, for example, you had a financial services company that is providing mortgages to an affiliated construction development company. So it's all about arm's length transactions and ensuring that the decisions that the mortgage company would be making about its clients are not affected by the demands of the construction development company. I've actually seen that happen. When I was with a bank, where we were making construction loans, we were also making mortgage loans. And we got to a point where the market in the 80s, sorry, going back a ways, the market in the 80s was in steep decline. Our construction borrowers were saying we can't deliver these houses because there's no mortgages. So on the mortgage side, we ended up getting concessionary loans, you know, steep interest rate reductions in order to get those houses sold so that we can maintain, you know, so we can keep the loans current on the construction properties. Those are the types of things that we look at when we have affiliated entities. Obviously, environmental risk on the consumer finance side is low, and social risk is also high, and that's about consumer protection principles, which, again, we're going to talk about some more. Capital markets deals are a little more interesting. The risk factors are primarily determined by the underlying assets. So in and of itself, a capital markets transaction is purely financial, and therefore environmental risk is low to none. Social risk also would be low to none unless you were selling retail, like if you had a REIT and you were offering shares to retail investors. But generally, capital markets transactions do not have the kind of risk factors that the other two do. So we talked a little bit about, Pamela mentioned the fact that these principles can apply at the project level as well as the corporate level. I'll give you an example of a company we worked with in Mexico where we were making a corporate loan to a developer that was going to be utilized for multiple construction projects. Each project had its own requirement for assessment of environmental and social impact. So each project and the contractors associated with that project were evaluated for compliance with primarily social and environmental principles, not so much on the governance side for the contractors. The corporate entity, which was managing, developing all these properties, even though the properties were technically owned by trusts, so they were held in fiduciary trusts, special purpose vehicles that were being financed as individual entities, we had to do an evaluation at the corporate level because they were the ones that were ultimately responsible for delivery of the product and management of the SPVs. And then we also did the analysis at the SPV level. And this would be something that you need to be prepared to work on. So we're going to talk about.
I just wanted to add a couple of things. One, I wanted to also get a show of hands. How many of you are directly involved in the construction or development of affordable housing? Not as many of you. Okay. Okay, good. I also just wanted to say that your profile may change over time. I mentioned that I'm working with TMRC. When we started TMRC, IFC came in as one of the investors, as well as Shelter, I think, who also did an ESG evaluation. But they both said you're very low risk. We weren't making direct loans to mortgagers. We were providing funds to banks who were then on lending to the mortgage. We weren't doing any construction. So we were very low risk. So we had a pretty smooth ride on our ESG due diligence with IFC and the other investors that were looking at TMRC. But now with the government coming in as a shareholder of TMRC, our business is changing dramatically. And we are now going to be doing microfinance, which is what Debbie was talking about, this consumer financing and rental, which is a whole different layer of risk. We're also going to be in some way helping developers build affordable housing in Tanzania. So our profile now looks very different. So we have had to embark in TMRC, and it was really led by the board because me, as representing IFC and other board members, said, you know, we're a different company now. We have to look at ESG very differently than we have been so far. So we are now embarking on developing a full ESG policy framework for the company because we didn't have it, we didn't need it. So you might be in that similar situation. You might have a risk profile at one point, but you might evolve over time. So this ESG is a very living and dynamic policy framework. You've got to really be looking at it all the time because your risks are going to change.
Yeah, that's a really good point. And I think also the number of counterparties that are involved in your business will also affect the risk factors. So if you're involved in, let's say you're in a partnership with a community development agency and you're doing financial capacity training, for example, for prospective customers, that partner would be part of your ESG framework discussion because there are risks associated with your company's involvement when choosing that entity and working with that entity to provide information to the public and making sure that that's done in a, in a unbiased, balanced way, that they're not. We had an interesting situation with a client who had developed an app for women who would be receiving student loans, and the app was providing a wide variety of services, budgeting services, resume writing, part of support, mentoring network. It also provided counseling services for girls who may have been affected by gender-based violence. And that just raised a whole flurry of issues with our social impact people. Okay, how are you going to make sure, that these girls are being treated fairly, being appropriately? Who's the counterparty, the counselors that are delivering the service? So it can be problematic to the extent that all of us are trying to expand our thinking into more creative ways to provide the services that our beneficiaries need. And unfortunately, it makes it sound like it's more complicated. But I think a lot of it is common sense. We'll talk about that some point. Okay, so let's just talk about governance very quickly. It's pretty obvious. When you think about it, it's pretty obvious. And for a small company, I think it's more difficult than it might be for a bigger institution or publicly traded, of course. It's going to be subject to certain governance requirements no matter what. The board is important. The quality of the board, the members of the board, their capacity to provide the proper information, real guidance to the company for its business. So selection of board members, a lot of times we see family members as board members, family and friends. And what we would be looking for in our diligence is that the board, even if it's small, even if it's 3 people, it's comprised of independent individuals who bring real expertise and knowledge in your business to the table. There's a whole process associated with selecting board members. I'll briefly cover that in the next slide. Internal controls, what this would have to do, this is more corporate policy. Who has approval authority for making payments, for doing procurements in a financial institution, how are credit decisions made. Again, a lot of that falls into the accounting business bucket, but it is definitely something that we want to see that there's some method where the board interacts with management in order to periodically review operations and make sure that everything is operating in a consistent, well thought out, written down in a policy manner. Regulatory reporting would typically apply just to financial institutions, but we look to see that you're up to date on your reporting, that you had no issues with reports, no objections, I don't even know what they call them. If your regulator comes in and tells you to fix something. Yeah, and anti-corruption, just looking for a policy. And this is an interesting conversation when it comes to development, but everybody should have a policy speaking specifically about what level of tolerance, it should be 0, your company has for paying bribes in various forms. Whistleblower, this relates to internal persons who have the right to call out, let's say, evidence of corruption or other issues that affect internal controls, for example. So again, you need a policy, a whistleblower situations. How are they going to be handled? How will they be vetted? Who will follow up? What actions get taken as a result? And then finally, a general code of conduct. A lot of companies have this in one form or another, but again, this is a broad statement of what the values are of a company and the expectations of how individuals behave within the context of operations. This is a good one for lenders, for example, if you have salespeople out in the field, or you have collections officers out in the field, that code of conduct is super important. All right, so what we've done here is we've given you a list of the kinds of things you will be asked to provide for the governance diligence. I'm not going to go through every single one of them. Just trying to see here. Shareholders, really important to know who the shareholders are. There will be background checks and diligence done on any shareholder that usually owns more than 5 or 10%. It depends on which entity you're working with. DFC, it was 10%. So there will be a requirement that shareholders, board members, and senior management provide information for detailed background checks. So you need to be prepared for that. The group structure and the organogram of the company, also really important, because that's where we can get into a discussion about affiliated transactions and how those are managed, and understanding also how the reporting structure works within the organization. Let's see. Oh, grievance mechanism. This is a big one. There needs to be, whistleblower is one thing, but grievance is a different animal. That can be external grievance or internal grievance. So if you, let's say you're building a development, a new development in a particular community, you need to have a mechanism as a developer for community members to come and complain about noise, about traffic disruption, bad behavior of contractor, of workers on the site, anything that could potentially be a problem that your activity is causing with the community. You also, grievances could come from your clients. It could come from your buyers or your renters. You need a place, you need to be able to say clearly to them, here's where you could go if you have a problem. Here's who you can talk to, and then you need to have written down a procedure for how you're going to address those grievances. And then thirdly, you have internal grievances. So these would be obviously employees, contractors, other counterparties that might have concerns or grievances. You need to provide a policy as to how all of those are handled. That's a big one we were talking about.
Yeah, I just wanted to add from my experience of working on the other side of it, of going to the DFIs and trying to get money from them. This is really one of their hot buttons. This is one of the things they will not give you a waiver. If you do not have one in place, and it has to be documented. And I found, when I was working for the private equity fund in South Africa, none of our developers had heard of grievance mechanism policy, didn't know what we were talking about. So we had to work with the DFIs to get a policy framework that they approved, and then we could work with our developers and help them to implement it in their own company. And I mean, there's just things about it. They want it to be anonymous, which doesn't make a lot of sense to me, but I have lots of fights with DFC and IFC and never won the fight. I mean, so they have some specific things they want in these grievance mechanisms. So I know it doesn't seem like it should be, but it is really one of the big hot buttons.
Anybody have any questions so far? Comments? Are you with us?
Yes.
All right, okay. The only other thing I would say, I want to point out here is record keeping. A lot of small companies are pretty, informal about record keeping. Even larger companies I've seen don't necessarily keep board minutes, but financial statements is a topic for a different masterclass. But it's really important if you're planning to pursue this kind of financing. Even if you're not going to, at some point in your life, I think you're going to be bringing in new investors, whether it's debt or equity, looking for grant money, and having a record of board actions, corporate transactions, all of these policies and procedures that are regularly updated, communicated to staff, are super important, and frankly, I think that they help you with good management, effective management. Do you have anything else you want to say about this list? Okay. Nobody else? All right. So we're gonna move on to social risk.
This kind of overlaps in some of the governance areas, but it really is quite an important part of the ESG. The S is quite important. Again, you're gonna look at it for both your own company and particularly what kind of business you're doing, whether you're working with developers, you're a mortgage lender, you're a microfinance company, you're doing mortgage-backed securities, whatever your business. So as Debbie mentioned earlier, a big part of it is that whole consumer communication and protection. That's become quite the buzzword. So if you are doing lending of some sort, you are going to have very good policies in place on how you're protecting those consumers from bad actors or from bad situations. Corporate community is really important if you're doing construction. As Debbie mentioned, that's a whole early in a development. You need to be out talking to the community where you're going to build this development, finding out, as Debbie said, what are the issues they might have with the project. You are going to probably have some sort of community liaison person that you're working with. We found that for our developments in South Africa, and Namibia and Botswana. We moved into Namibia and Botswana subsequent years and finding now they're actually in Kenya as well. But we found that that liaison person became part of the project management team. So they came to the project management meetings for the project that our fund guys, our project manager for the fund, was working with the developer, and they were just part of the discussion. So not only when we started the project did we have to address all of their issues, but we made sure we were continuing to address the issues as the project proceeded. We talked a lot about the grievance and whistleblowing. I think the only other thing, again, some of these are really more relevant to construction, like workforce safety. You have to have workforce safety for your own company. You need to show that your employees, and particularly nowadays, this whole wellness thing of your own employees has become much, much more important. And we really are finding, in this little handout we wrote for the conference, we got some statistics, and then a very large number of employees actually, it's a key driver of how they feel about the company they work for. Does their company value them as an employee and treat them well, and are they concerned about their well-being? So I think this is becoming a bigger issue, and if you have good policies and procedures in place of how you're addressing, are you paying fairly? There's going to be a lot of different things they're going to look at. We're going to get into some of the details of what you have to measure to show you're actually doing this in a good way, and then marketing practices.
Can I just say that, also, you know, if you're a bank and you're making construction loans, and again, you know, the financing is coming from one of these entities, these issues are going to apply, so they will apply to your downstream lending activities. Displacement of persons and livelihoods is something that comes up pretty often. In Africa, we had a situation with a project in South Africa where there were squatters on the property. They moved onto the land while the developer was getting ready to start construction. And it was a protest occupation, basically. And the government, municipality said, we'll get them off, you know, we'll get them off before you start. They promised the developer they would do it. What happened with DOC was that we required that the developer take responsibility for making sure that the government did what they said they were going to do. And it needed to make sure that it was done in a humane way. So you get into these conversations about compensation, even if you had, you know, informal farming going on at the site, the compensation for those people, well, we'll talk about that in environmental, but these are the kinds of things that you may not think it matters for you at the financing level, but they can come into play if you're doing downstream lending. And we're going to get into the consumer protection stuff, right? There are some references in the handout about the consumer protection principles, I think, the city's website.
Yeah. Okay, moving on. Next slide. Are you the clicker?
Oh, sorry.
She's falling asleep at the job here.
Okay, here we go.
So, again, we were talking about some of these different social risks from the construction side versus the financial side. As Debbie mentioned, from the construction side, you're going to look at security, especially in Africa. All of these projects tend to have some sort of security, or you will have no building materials when you go to work the next day. So, I mean, that's pretty much worldwide, not just Africa. But one of the things that the DFIs care about is, are these guards armed? Do they have guns? And so they're going to want to know, are you hiring a service to do your security? Are you managing it yourself? How is the security of these projects being done? Do people live on site? Do your construction workers live there part of the week and then go home on the weekends? There's all kinds of security issues around the construction site. And then, I can't even see what that says. This is the compensation that Debbie talked about of the displaced. That can be indigenous people. We had pretty much every situation that could possibly happen. In South Africa, we had indigenous people, we had squatters, we had mining. They were one of our projects we found out through the EIA. There was a previous mine many years ago, but there could be still some residual bad things from the mine. We had a graveyard that came up, which was a huge issue for the DFIs.
We had an issue with that in Rwanda also.
Did you? And was this on a construction site?
It's me. It's me. Hello. It's me.
I can see.
It's me.
Somebody completely different. Oh, okay. Sorry, Debbie.
Yeah. We were looking at a university construction project that was adjacent to a mass burial site. So basically, not doing.
Yeah, we ended up, it really had a major negative impact on our cash control. Has anybody ever experienced any of these? Make sure you're lending with very fair practices, you're not discriminating against certain groups of people, or, you know, what are your collection practices? Again, that's going to be very different if you're doing microfinance lending or you're doing mortgage lending. Those are gonna be, quite different and need to be well thought out. Have you really thought what all the impacts might be? Not only do you need clear intent, you need good contract terms for your mortgages or rental contracts, all of these things. But one of the things that the DFIs really look at is also your internal contracts with your own staff, your HR policies. They consider that it's kind of part governance, but it's also part social. So you're going to want to make sure you have good employment contracts, whether they're temporary staff, whether they're full-time staff, clear terms of what their work is, how much they're going to get paid. So you really have to make sure you're treating them fairly, that there's no discrimination. Credit decisions, multiple avenues of communication. Debbie talked about them, that they have ways of letting the company know that there's a problem and it's going to be addressed and it's going to be fixed. And collection, training is very big, both, your own internal, but you may also be needing to train, like if you're someone like TMRC or KMRC or NMRC, you're going to be training your customers as well. You might be training borrowers to understand the mortgage business. You might be training your banks to understand your underwriting criteria, how the mortgages, what are the eligibility criteria for the mortgages that they can get on lending from you. I know from experience of what TMRC is doing, it's a major social media, other training. They're working with the mortgage associations. They're really building a whole network of how to train the whole ecosystem that might be involved with housing. And protection of clients' personal information, quite important. This whole data and privacy issues is important to the DFIs.
I think too that this, we call it financial services, but it really relates to any consumer interaction activity. So if you're renting, this applies to the treatment of tenants. It applies to like a lease to own type of an arrangement. So same thing, all of these issues apply in those situations as well. We had a project in Honduras that was a combination of construction finance and long-term financing for the buyers. So it was a true lease-to-own program. These guys were good developers, but they had never managed a portfolio of receivables, right? Consumer receivables. So they had to build from scratch this entire process. And not only build it and write it down, but they had to show how they were monitoring this, because they were training people in Honduras to deliver these policies and procedures. But what we found is that they really didn't have enough supervision of those folks. So yeah, it was all there, the policy was there, but it wasn't being implemented the way it was supposed to be implemented. So what's going to happen is there will be people coming in to check it out and see if things are actually happening the way the policy says they're supposed to happen. And then, if they're not, basically get into a remediation kind of an exercise. I've never heard of a loan being called because of that, but he would definitely be held to account in some way. I'm trying to think of other examples. Student housing, same thing, just like rental. What else? Oh, servicer. So if you hire an outside party to do your collections, or you hire an outside servicer to manage a portfolio in a capital markets transaction, servicer or the collections agent, they're held to the same requirements. So you need to demonstrate that They have those policies, you've reviewed them, and they're consistent with your own internal policies, and you are regularly auditing them to make sure they're in compliance. Okay, anything there? No, all right.
And maybe it's good to just point out, maybe I should have pointed it out earlier. We're talking about all these different, the social, the government, and the environmental. But what happens when you get through this due diligence process with the DFIs and you aren't in compliance with one or more of these things? Generally, it depends on the severity of how far you're outside. But assuming you're just missing some of the points in here, they're going to most likely set up a remedial action plan with you. They're going to go ahead with the due diligence, and they may go ahead with the transaction, and you may get the funding from them at some point. But they are going to say, these are some things you have to fix, and we're going to give you this amount of time to fix it, and we're going to review it periodically, and then once it's clear, the remedial action plan will drop off. But that, that is generally the way that they try to handle this. So, and ways that you can actually measure or know if you're meeting the social aspects. These are just some, it's so small I can't even read it.
Can't read it. I tried to make it bigger, but.
Bad job there. So again, this was probably the most complicated thing when we set up the ESG procedures for the fund in South Africa. And that was because IFC was coming in as investor, but so was we had several other of the DFIs coming in as investors and pretty consistently asking for the same thing. So we had to then, we were looking at the social impact both at the corporate and the project level. And probably one of the most complicated things was how to get this data from the developers. Now, there's probably some fintech going on out there these days that would help you do that. I hope so. I think there probably should be. Listening to some of the presentations yesterday, it was quite encouraging to see we're making some big strides. So hopefully this process is getting easier for you, but you really have to know how you have to break down your staffing, how many men, how many women, how many full-time, how many part-time, how many disabled employees you have. In South Africa, we had to track previously disadvantaged. Other countries might have other sort of things of measuring that. Whether they're foreign or local, there's, so you're going to go through all kinds of things that you're going to look at. And one of the other ways that you're meeting it, the sort of to make sure, is your HR policies. Those are critical. Do they have all those components we're talking about? Do they have a code of conduct? Do they have grievance mechanism? Do you have your hiring practices? Do you have contracts for all your employees? Everybody knows what their terms of employment are with you. Do you have ways of disciplining and dealing with your employees that aren't performing? What is your policies for bonuses and payments and other things? All of this has to be documented, and you have to be able to show that, you're actually doing it. They're going to look at some of those employee contracts. They're going to look at, and they're going to talk to the staff and say, are these things really in place? So, these are just the kind of ways that you make sure that you have the things that you need to show them that you are meeting the social diligence aspects of this whole process.
Yeah, and to the extent, on all of these things like grievances, whistleblowing, anything that gets done under these policies, you may be asked for records of how many how many grievance requests did you receive, how many were resolved. They want to see that these policies are actually being implemented and that management is tracking the effectiveness of the policies. Yeah, you're probably at this point going, I'm never getting money from the buy. But, it's filtering through the whole financing ecosystem. So I think it's worth addressing all of this regardless, like they say. Okay. So environmental risk assessment. This is something that everybody's a little more familiar with, and there's really no point in going into all the aspects of an environmental impact study. That is a thing in and of itself related to the development of a project. But there are a couple of things that I just think, if you're looking at sites that you want to be prepared for. Now, the thing I mentioned earlier, the size of the project. So 2,500 units or more, that definitely would go into category A. Most housing projects, in my experience, have been what we call category B, which is minimum, medium risk. And did not require any special, any particular, special report or public disclosures or anything like that. But there are some things that can create issues. One I want to point out is solid waste removal. And a lot of times, if you're building a project and you're setting up a homeowners association, we would be looking to see that there is built into that contract for solid waste removal. And solid waste treatment during construction is also super important. To what extent are you recycling, construction debris? How is it being stored on the site? How's it being managed? What else do I want to point out? The body of water nearby, wildlife impact, those. Years ago, I was out on the river and with a guy who had acquired a piece of land out there, and he took me around the site, which was still raw land, in his truck with gun round, and there were game all over the property. And I was saying, what are you going to do with these animals? The DFC is never going to approve any kind of loan if you have all these animals. Are you going to go around and shoot them? So he says, no, we're going to move them to the game farm across the street. And it was like a preserve, a game preserve. I guess they serve the animals and they also take care of the animals. But anyway, we didn't really finish that project. There is the whole thing about indigenous, greenery, removing trees, replacing trees. We definitely talk about that, green area maintenance, and I think that's kind of standard practice nowadays for housing developments anyway. But I think what we're looking for, the body of water device, we have a project in Sri Lanka, a nursing school that was right next to a creek. It's like a small river creek that was completely contaminated with people living on the other side of the river in informal housing, and it was bad. The municipality said that they were going to clean up that creek, but nobody believed them. Let's face it. It was a similar situation to the guys who were occupying the property in South Africa. Nobody believed that the municipality was really going to take care of it. It was going to cost money, and Sri Lanka doesn't have money. The public sector does not have money. So we required that the developer put money into the project in order to resolve the previous situation. And they went above and beyond that. They actually put in like a swamp area, a buffer area for water runoff with lots of greenery and pathways, and they actually turned it into kind of like a public access park. So these are the kinds of things that this was a nursing school, it wasn't like a low-income housing project. So they had money, they had some budget that they can use for this sort of thing. But those are the types of creative activities that can be included in this analysis and this proposal that will make a big difference in the way you, not only the way the risk is assessed for your project, but also how it scores from an impact perspective. Anything you want to ask about environmental? Okay. Oh, proximity to public transit is also major. Really are trying to get away from financing projects out in the middle of nowhere. Okay, impact.
Okay. So we all know that anything you do in housing is going to be risky. I mean, housing just inherently comes with risk, no matter what part of the ecosystem that you're using it. But I can tell you from practical experience, not so much my experience at IFC, but my working in the private sector or with various companies, that when you're doing these things that we're talking about, you can really start to measure your impact, but you also feel like you have a much better handle on the risk. We want to do housing. It's so important to all of us, but we have to find ways to do it that we're protecting all the different people. But I think the fun part of this, I know it's the hard part when you're the company having to do it, and having worked for companies that we've had to set up all the measuring, the monitoring, the reporting. Reporting to the DFIs is a pain in the neck. Actually, another part of the anatomy, but I won't say it. But it is a tough part of what you have to do if you do get that DFI funding. But it also makes you feel very, very good about what you're doing, because you start to see the tangible results of what you're doing. And so we're measuring, I think there's a lot of ways you can measure on the construction side what kind of impact. There was a lot of talk yesterday about job creation. And this is hard. It's hard to get your developers into the habit of giving you this kind of information on a quarterly or semi-annual or annual, whatever your investors are requiring you to do. But it is so well worth it. You really have a very tangible impact. But you're going to have to, it becomes quite granular. It isn't just, okay, how many people are employed in your project? It's how many skilled workers, how many unskilled workers, how many women, how many men. There's all kinds of granularity that you want to get into to really start to see. And you see that the number, and it's going to change quarterly because the projects change. You add more projects get done, they're sold out, they're no longer in your portfolio. So it's different projects, but at least you're starting to see and track over the years what kind of impact are we having. Especially when you can start showing the DFIs or others, or just in your own corporate, your annual reports or your sustainability reports or your ESG reports that you might end up doing. You can just show, we are actually providing this many jobs for unskilled labor, which is a really big positive thing. Technology was a big discussion yesterday. What kinds of alternative building materials are being used? One way we were tracking that was we were using the IFC Edge tool. We were one of the first companies in South Africa to use the Edge for residential, and that was a great way of us to actually, again, to be able to quantify what's the water savings, what's the electricity savings. But stimulated us to do so much more. We started to see, just from what we were tracking for IFC, for the EDGE, we then came up with much more innovative ways at the project level. We could install these little things in the unit that help the actual consumer, the person living in the property, to monitor their own usage of electricity and water and track it. But one of the ways that we found was really helpful of giving some of this information was doing a survey of our projects, to go out and talk to the actual people who were living in our rental units, as well as our for units for sale was a little bit more problematic because we didn't have a direct relationship with the end user, so that was more difficult. But a big part of what IHS was doing was on the rental space, and they, for various reasons, decided they had to set up their own property management company to manage, because it was such a big part of their portfolio, and it wasn't easy to find somebody who could manage the assets to the standard we needed to meet all of these ESG requirements. So we set up our own, and that then gave us the ability to have project managers actually living on each of the sites. And we used those asset managers that were living on the property to help us get this kind of information. How they were the ones taking the applications. They know who's living in the units. Are they women-owned units? How many people are living in each unit? What kind of income levels are they using to qualify to get into these units? We got really rich, good data on the rental stuff from our own internal company. But the surveys were extremely helpful, asking the people living there, what do you like about this development? What don't you like? What aren't we doing well? What's not working for you? But we kind of knew it intellectually, but to hear them say, the most important thing is you've helped me to have a place for my children to get educated near where we live. I don't have to travel so far in a taxi to get a job. I'm now able to get a job in my own community. We have churches, we have synagogues. These were the things that they would tell us. These are the things that are really positive. And again, that just makes you realize what you're doing is the right thing. That, that's what we want. And it helped us then when we were moving on to our next project. Okay, take that feedback. What do people not like? What do we need to improve? How can we make our projects better? So it was really so there's lots of tools you can use to get this information. I would say clearly the hardest part is to get that data from your developers. And again, I'm really hoping we can use technology and AI to help in that regard. I think that's pretty much all the construction impact.
Yeah, I really recommend trying to collect as much of that information as we can. First of all the conversation yesterday about data and how important we need to make the case for why affordable housing matters. And one of the challenges that I had every single day with getting impact scores for housing projects is all they look at is the price of the house, and there's so much more indirect value to providing quality housing to people. And the trouble is we have no way of measuring. Yes, ma'am. I just said, in the bottom we've got health, education, wealth building. We don't have the means to demonstrate those impacts right now. So the more people can try to collect that information, and if you become armed with that information, you will, let's put it this way, we all want impact, but in a very quantitative, practical way. If you're dealing with a TFI, you want a high impact score. A high impact score gives you flexibility, it increases the appeal of your project, and it increases the likelihood that maybe if the risk is a little higher than what they would like, they'll do it anyway because of the impact. So there's an altruistic reason and there's a practical reason for all of this.
I think this is very, very interesting, and so I look for DBSA already advised. And I find that we.
Thanks very much, Debbie. Now, I was just saying this is very, very interesting, and I quite like how practical and granular you've been able to be with it, because sometimes we have our own ESG team, and it can be a little bit of a high level. And I'm sitting here thinking in a very, very practical way, even as a lead originator, one can start creating this in our projects, and we start to speak of that impact. What I'm finding interesting is that when we look at lending, particularly to intermediaries who then aren't lend, you aren't able to give the richness of this information that you speak on. But certainly, once you start looking at the project level lending, then you can start to pull this information out. And when I consider our credit committees, that's why there's always a preference for project financing, at the construction level, as opposed to lending to the intermediary who then unlend to the sponsors and project owners where they themselves are able to get the information. So then at that intermediate level, you can't articulate it as well as you can at project level. So I just found that quite interesting. I wanted to make that point.
Right. Masterclass.
Thank you, that was great. I just wanted to also say, one of the processes that we implemented at the fund was that once we had set up this ESG policies and procedures, every deal that went to investment committee for a new project had to be signed off by the ESG officer. So that due diligence was first and foremost, before we actually spent the money for the full due diligence. We had done our preliminary due diligence. We felt like the project might have some legs and we might want to do it. But before we would commit to doing a full due diligence on the project, we did the ESG due diligence. And that had to be signed off. So the deal maker who was working on the project would work with the developer to complete the questionnaire, get all the documents, review the documents, and then they would, and I would get together and we would go through and we would set up then remedial action plans for the developer if they didn't meet some of the criteria. But we would say, okay, we approved this, we signed off, but that was the first document that the investment committee had to see before they would proceed to the full-blown due diligence. And I think that worked well because then if that was way off, we knew the project was probably not going to move forward.
Yeah, that's interesting. It's usually ESG gets tacked onto there. Okay. I think we've covered this on the construction side. You notice there's nothing in here about affordability. Affordability is definitely an overarching issue on both sides, on the finance side as well as on the construction side. But I do think we need to work harder to make the case for the way we develop these projects and not just thinking of price, but thinking of the benefits of rebuilding and savings in utility costs and savings for transit expenses, other ways that building in a more modern way, in a more sustainable way, improves the affordability of the property over the long run. Right now, though, we really don't have the mechanisms to demonstrate that consistently. But I think that's something that all of us in the industry are hoping we can get going. Okay. Okay, on the finance side, yeah, so impact on for mortgages or rentals, lease to own, capital markets transactions, again, it's the same situation I mentioned earlier. So if you're doing some kind of a mortgage-backed bond or, you know, multifamily rental-backed, you know, like a REIT, most of the impact value of that exercise is going to be based on the downstream activity. However, in some markets, you can get credit for financial sector deepening and financial sector innovation, which we got, for example, with the CRH transaction that we did last year, year before last, as it was, where we're using a cross-border bond type transaction to bring more long-term capital into the African market. So they did get a highly developmental score for that deal, partly because it was focused on affordable housing, but there was a huge component of it that related to this financial sector innovation side. So the other area where you can get credit beyond the obvious on the financial services side would be technology. So to the extent that we have had some non-bank financial institutions that are using digital application methods, apps for hiring sales agents and contractors. There's a guy in the Philippines, company's called Lupa, and it's a really cool model for developing or rehabilitating. They acquire distressed properties at a reduced price, they rehabilitate them, and then they resell them, but at an affordable rate, because they are able to do that. You know, they buy them at 40% discount, they spend maybe 10% to rehabilitate, and then sell them at an affordable price. But all that's done through a distributed network of app users, both sales representatives, contractors, and then individual buyers. So that type of innovation in financial services is definitely going to score well for impact. Other than that, you know, you're talking, are you going out into the community and offering, you know, financial skills training? Are you actively working with customers in understanding home ownership? You know, if you've got a lot of first-time home buyers, the bank or the lender could be out there working with families to say, what does it mean to own your home? How should you expect? What kind of money are you going to need for maintenance? I was thinking of one while we were talking earlier, homeowners associations. So this is something a developer could do. It's also something a financial services company could do. Homeowners associations are created a lot of times, but they really, people in that community, especially a lower first-time homebuyer community, have no idea how to run a homeowners association. So they need help there, and that's the kind of activity that you can do to boost the impact of your bank financing proposal. Every single bank deal that I did at DFC, we were constantly pushing down market. So at least 25-30% of the lending activity had to be at the lower end of the bankable sector. So, you know, 40 to 60% of median income would be how I would classify that. So obviously the lower end of the price range, lower income levels, underserved markets, indigenous people, refugees, all of those are really important in financial services. What else? We got a lot of impact credit for, so if you're doing a lease to own, one of the really useful aspects of that is that you can finance somebody for 3 or 5 years under a lease to own program. They build a credit record, they build a track record of payment, and demonstrate that they're able to make that monthly payment at that level. And then they should be mortgageable at that point. They should be able to go to a financial institution and get a traditional mortgage at hopefully a more affordable rate than what we may be offering. So to the extent that you're involved in that financial literacy and pathway to creditworthiness and bankability for a family, that adds value to our financial services project. Anything else on with that? I'll just say one thing about pricing. The interest rates, so there's this tension between interest rate, from an impact standpoint, we want interest rate in the terms of the loans to be as affordable as possible. But from a credit standpoint, we need to be sure that there is enough revenue being generated and that the pricing is accounting for the risk and potential loan losses, so that the loan can be repaid. So there's always this tension in that area, but I guess what I would say is that to the extent a financial institution or one of these rent-to-own any financing entity is designing a set of credit criteria that's targeted to the needs of a particular population that is underserved, as long as you can demonstrate that you have clearly assessed the risks and accounted for potential losses in your financial modeling, you can do both. You can do both. It's not about interest rate alone. It could be about other factors that have been, that are barriers to affordability and for entry-level families. So I guess what I would say is this is another area where if you show that you're working hard to serve a population that is underserved, there may be more willingness to accept higher risk on the financial side in exchange for that groundbreaking effort. Does that make sense? Are you with me on that one? Okay. Because I know a lot of people are trying to do that sort of thing.
I'm about this country. Just a basic question. So what you mentioned about the project credit being the main country, right? I mean, in Pakistan, at least all the developers that have gone out by the Securities and Exchange Commission of Pakistan, if you're developing a company which is lead, you need to have at least the policy. There's no choice. You need to have it. However, developers have struggled to go out to get some financing from PFI, primarily because the costs associated with workforce housing is a little bit higher compared to normal housing. So have you, in your experience, seen anywhere in the market where investors would price in the fact that they have an ESG policies, they're following all the guidelines, and maybe discount that, or again, just running on the pricing? Because we haven't seen that in Pakistan, and developers are not interested anymore because they feel they haven't been able to get subsidized financing from the advice. That's for you as well, Bangalore, because pricing is also on that board. We went down, we wanted to refinance a project which had all of these components. At the end of the day, the investors were more concerned about their capital. We couldn't find any investors who was interested, both local and foreign, who would probably give you some advantage on the pricing for the developer to either have his ESG policy or green guidelines from ISC. We tried with all green bond principles, like we should have, but we couldn't really find any advantage in terms of pricing.
One thing I would say, it's a really good question, and it is very difficult. And I think that's partly why the DFIs now would not prefer, I don't think they prefer, but one of the ways of dealing with that is to set up funds like IHFs, who are doing nothing but giving money to developers to build affordable housing. Then they don't have to be the one trying to deal directly with the developer. And I think, with the mortgage refinance facilities in Africa, that's another way. Maybe the DFI isn't the best answer for the developers directly. I don't think they have the capacity. I don't think they will understand how to look at the risk like you're explaining, because that's not their core business. And so I think it does make some sense, and all these mortgage refinance facilities are getting funding from the DFIs and from the governments in most all cases. They've got government subsidies as well. So that's why we're trying to do at TMRC is, and I know KMRC and NMRC are doing the same thing, trying to find ways that we can build the subsidy, we can manage the subsidy. We're not trying to get the DFIs to give them a subsidy, because that just isn't in their wheelhouse. They don't get it. And so I think we have to look for more creative ways. But I think I'm feeling more optimistic that there are more channels. I think in the past, there weren't very many channels for developers, except to try to go to DFIs.
Yeah, I think the answer to your question is no. I would say ESG is a threshold issue. That is, nobody's going to talk to you unless you have a policy in your, you basically be told, go away and come back when you're ready. Back in the day, we would have, my team would have spent time working with a client during the process while they develop these policies, but nobody has the time for that anymore. So you either, show up with something. There may be some back and forth, but at least you have something. So I think it's just it's a primary factor to get a hearing at all. And I have seen real evidence of reward in terms of, pricing. Yeah.
And will the banks provide financing to the developers?
I think there's also like finance. At the end of the day, whatever it's your majority of your registration already looking for whether side of the data or and you need at least one moment now level to build the project. So it's really kind of generally the development needs not very many. So these ones the major issue that falls down is you will be willing to pay 15% more when you've already started with interest rate of 9%. More sustainable, doesn't really matter. And so for the banks, the challenge is one of the way to make it that. So we do bring it a guarantee, so all times it's getting the share. Right. Bring it on that.
Right.
But at the end of the day, the banks, even with the guarantee, will give you any discount. The fact that it's being developed that they gave you policy. But for the virtue of you to be nothing but it's not, we have to have a guarantee policy. And that you cannot have license. And that goes out of you have a policy, all the policies that you can do that. But the companies don't carry the subsidized financing, there will be additional cost of the saving. Yeah, that is why Pakistan it is at least more feasible to pay the do sustainable development.
In that rural, a few years ago, we haven't actually used it that much. But basically, what the gentleman is saying is that there's no financial recognition for building sustainably, and recognizing there is an increased cost. And that's one thing we were doing at DFC. We could not get approval to do lower rates, but we did get approval for an EDGE certified project to do higher leverage. So how I can't even think of a single time that we actually used it though, So I don't really have an indication of how that affects the economics of the deal and whether that actually compensates for the cost. And it really depends on the location. Some places, it's only maybe 5% increase, others at least significantly more. So, right. Yeah, there's no easy answer to that here. my personal feeling about the whole green building thing is that we need to show buyers, the 5%, slightly higher price, how it gets repaid for them. We need to market this better. That's an area that I actually thought ISC with the EDGE program could help more with, to come up with a more really focused, good consumer communication program. Anyway, and this is our last point, and I'll just sort of drop it in at the last minute. If you ever hear of the 2X, so in the context of this process, you're going to be asked questions as you saw. How many female employees do you have? How many female board members? How many women in management? How many have women shareholders? And then, of course, how many women beneficiaries are you working with? This is, for DFC anyway, this is also a threshold issue, especially, doesn't really affect Africa because other than, what do we have, Namibia, Botswana, South Africa, or urban countries. It really only would affect those 3 countries, but DFC, you have to have, your project has to qualify for this 2X criteria. And it means that you have to meet certain thresholds on your beneficiaries as well as your leadership team and employment. So something to be aware of, because the DFIs have signed on to this 2X challenge, which means that X% of their projects, their financing, has to go to projects that meet these criteria. Doesn't benefit you as a client, really. I haven't seen it where somebody is saying, we're 2X certified. It's more of a challenge of the DFIs to say, okay, we're really going to push for gender equity. However, you may find that this will affect your impact score, and in some cases, it could be a threshold issue for access and financing. All right.
I just wanted to make one point I meant to make up front, and it didn't. In this handout that Keisha is going to be providing you, that we drafted, we also provide you a pretty long list of resources, where to go look. And one of the key resources is the IFC performance standards. Maybe you've heard of them. I think that's where you would want to start if you were really just starting this journey to look at ESG, because they are sort of the standards. All the DFIs are pretty much using the IFC performance standards as sort of the core basis of what you're doing. So it's worth, and in the handout, we actually list the 8, I think it is, performance standards, just so you know what they are. But we also give you some links to go and look at them in more detail, and many other sources to look at. So this is we were just hoping to whet your appetite and give you a little peek under the tent of the very obtuse DFIs. So hopefully that was helpful, and hopefully the handout will be something you can use to then further. And certainly you're welcome to reach out to Debbie or I, and we'd be happy to talk to you as well.
Thank you all so much for coming. I hope this was a little bit useful. You walked away with a couple of ideas and understanding of what this whole process is about. That was our objective. Good. Have a great rest of your day.